I see that number of participants increase. Okay. Hello, everybody. Good morning. We are really happy to see you at our panel discussion. This is our second session, and today we will look closer at the intricacies of tax residence in Belgium, Netherlands, Slovakia, and Great Britain. We know that questions are very hot and very important for a number of Ukrainians who are abroad now due to the war in our country. And we understand that this topic is also very relevant for legal entities, because management of a number of companies are also abroad at this moment. And we will try to cover today a number of questions, practical questions that each of us who are abroad now will face in the nearest future, or maybe already faced in their country of their residence at this moment. And I would like to remind our participants and our listeners that you have the possibility to ask questions. Please use for this Q&A button. We will try to cover and to address as many questions as it will be possible. But of course, we saw from our previous session that number of questions is really big, and some of them will be addressed in another way in written option. So you will receive your answers after our meeting. Also, we have a recording of our panel discussion today, and we will share this recording with you as well, together with presentation. I also would like to remind our participants that our panel discussion will consist of two blocks. The first block will be their general overview and presentation on countries that are today under discussion, Belgium, Netherlands, Slovakia, and Great Britain. And after, our colleagues from PwC globally from mentioned countries will also join us, and we will be able to ask our practical questions to them as well. I am happy to introduce our first speakers, Anna Stepuk and from PwC Switzerland, and Anna Nevmerzhitska from PwC Ukraine. And also on your screen, you can see now all other speakers of our panel discussion. And I am happy to give the floor to our ladies, to both Annas, to present the first part of our panel discussion. Ladies, the floor is yours.
Thank you so much. Thank you very much for the introduction. Thank all the participants who joined. Also for those who joined our previous session, welcome back. We will start with a recap of legislation in Ukraine, also in the relevant countries. So for those of you actually who were present last time, the first 15 minutes going to be quite similar, because we will still want to make sure that we have all the common basic understanding of the residency concepts in all the jurisdictions. So that's why, in case you hear something you heard last time, please wait for 10-15 minutes, and then we jump into the international legislation of the countries of relevance this time. And so we start our presentation and first part of today's presentation with a recap of the basic concepts of Ukrainian domestic legislation, especially such as the term as tax residency. In order to determine Ukrainian tax residency, we would refer to Ukrainian tax code, and there are actually a special test to be passed to understand whether an individual qualifies as tax resident of Ukraine. It's a step-by-step criteria you see on the left part of the slide. So first, individual has to consider whether they have place of residence in Ukraine or not, or in several countries. Then proceed to second criteria, which is place of permanent residence, not specifically defined in legislation, but practically we talk about some permanent home available, and we see more and more authorities looking at the relevant time spent there and registration in Ukraine. The next criteria is central vital interest. The tax code gives two major examples: is family and registration as individual entrepreneurs. However, it could be very broadly interpreted. So you have to really look where the ties of the person is and where the ties are stronger with Ukraine. Then there is 183 days test, and then it's passport. So all these criteria apply as a step-by-step approach. So we have to consider first criteria. If it doesn't apply or applies in several countries, go to the next one. Therefore, what is important here to keep in mind that 183 days is not the first criteria for becoming Ukrainian tax resident, and not the first criteria for generally assessing tax residency based on the domestic legislation of Ukraine. And B, it's not that actually if the individual want to lose Ukrainian tax residency, it's not that easy, because you need to make sure that all the criteria are not met in Ukraine and is met in different state. Of course, when we talk about conflict of tax residencies, and this is the major topic of our discussion today, we refer to so-called double tax treaty. It's a treaty which actually gives an explanation or defines the taxation basis in case the two jurisdictions have a conflict. In our case, we talk about tax residency. Ukraine has a vast double tax treaties also with the countries we're talking today. And if there are potential risk of double residency in Ukraine and the treaty country, then we have to go to so-called treaty tiebreaker rules. These are on the right side. You can see the typical criteria, the standard tiebreaker rules you have in basically all double tax treaties Ukraine concluded. So first criteria is permanent home, second is close personal and economic relationships, third criteria is habitual or both. Again, here people sometimes refer to 183 days, but it's not necessarily the case. It's basically the Monarch Convention, and the interpretation goes more towards where the individual spends relatively more time in comparison to other jurisdictions. And the fourth criteria is passport. So again, you see there is some similarities between the domestic rules in Ukraine and double tax treaty. And both cases, we have a step-by-step test. So we have to go each after each. It's not a joint combination of the criteria, but we have to go step by step and consider each criteria separately for each country of interest. So this is about tax residency of individuals. Now we move towards tax residency for legal entities, and I give word to Anna, who will talk more about legal entities.
Thank you, and good morning to everyone. Yes, about tax residency of legal entities. So here, at least in Ukrainian legislation, we have quite easy rules. So basically, any legal entity, any company that is registered under Ukrainian law is determined to consider it as a tax residence of Ukraine and a taxpayer in Ukraine. So it's basically very easy rules to follow. But at the same time, because the topic of today's webinar is about relocation of people, actually, because of relocation of people, there might be some difficulties as regards to determination of the residency of Ukrainian companies as well, or better to say, there might be triggers of taxable presence of Ukrainian entities abroad. And here, to start this discussion, let's first of all focus on those concepts that exist in Ukrainian legislation. So permanent establishment is defined both in Ukrainian tax code and in double tax treaty, and signed by Ukraine and other countries, and the rules are pretty much similar. So if there is a permanent place of business through which a Ukrainian company, in our case, is conducting any business in foreign jurisdictions, such permanent place may be considered as a taxable presence, which is basically permanent establishment and subject to taxation in that country where it's basically deemed to exist. Apart from the permanent place of business, important matters are that the fact that people, employees of Ukrainian entities residing now somewhere in foreign jurisdiction and continue to conduct activities and functions with regard to the transactions and operations of Ukrainian company might be also a trigger for recognition of permanent establishment in that country where such people reside. Interestingly enough, that when we look into the definition of Ukrainian tax code, there is also one of the triggers is the place of management. And if the place of management of foreign entity exists in Ukraine, then the permanent establishment of a foreign entity might be also recognized in Ukraine. And I just would like to stress here that we will go further for overview of the respective foreign jurisdiction, and we will see similar rules. Therefore, this fact of moving people from country to country might be important to determine whether the residency of the legal entity, as well as the place, the jurisdiction where such operations and transactions of such entity should be taxable. Important matter is that when I was talking about residency of legal entity, I just mentioned that registration is sufficient to consider an entity as a taxpayer in Ukraine. That is because we don't have any other criteria. Although recently we introduced so-called concept of place of effective management. Anya, can you please move to the next slide? Which is slightly similar to what we will see in other jurisdictions, but with some deviations, let's say. So basically, place of effective management of foreign company exists in Ukraine if, for example, the actual management of a decision-making process of that company is being conducted from the territory of Ukraine. An example of such basically management process in Ukraine might be either the fact that the majority of board of meetings being held here, or the daily day-to-day decision-making process, so like all decisions with regards to both daily operation as well as strategic operation of the foreign entity is being done by people located in Ukraine. So basically de facto the management is being held here. And as an indication of this fact might be, apart from the board of meetings held in Ukraine, might be also the fact that Ukrainians or people located in Ukraine actually operate banking account of the foreign entity, or for example, accounting of this foreign entities are being done by people located in Ukraine. So basically all personnel, key personnel and accounting related personnel is here in Ukraine. So basically, why this place of effective management concept is different from the worldwide, let's say, is the fact that an entity, foreign entity with such functions and with management in Ukraine is not specifically mentioned as a resident. So it's an interesting point that basically foreign entity might be considered a tax resident in Ukraine, while and subject to taxation, while, for example, Ukrainian entity from Ukrainian domestic tax perspective, tax rules cannot be considered as a foreign entity as a taxpayer in other jurisdictions, simply because we don't have a criteria or place of effective management in the domestic legislation clearly included into the definition of a residence of Ukraine. Therefore, there might be issues while a few countries might consider the same entity as a taxpayer based on various criteria. In Ukraine, that would be simply registration. In other countries, that might be also place of effective management in case people relocated to other jurisdictions are actually decision-making people, and they reside in some foreign jurisdiction and effectively conduct management of Ukrainian company from that territory. That issue.
Sorry, and how it will be determined, or how it will be checked that the management is abroad on the one side, and what if the management is a number of people and they reside in different countries, for example?
That's an interesting question. Basically, there is no like black and white rule which will allow you to say that actually the place of effective management is in this country or in other country. So it should be a complex matter, should be analyzed from various angles. So it depends of how many directors basically the company has. Of course, if just one person out of 10, let's say, board of directors reside in foreign jurisdiction, while the rest is in Ukraine, that would not be an issue, but the same should be, so it indeed depends on a particular case, which should be analyzed case by case. So if the management spread across various jurisdictions, that's likely we will have the Ukrainian test being met, which is very simple. Yes, we have the Ukrainian entity registered in Ukraine, subject to taxation in Ukraine, and it is unlikely that other countries having just one director of all board of members can require from Ukrainian entity to become taxable in that jurisdiction. So it indeed depends on that. But of course, if we have one director or two directors who left Ukraine and currently reside in some foreign jurisdiction, in the same foreign jurisdiction, and continue to maintain, like, board of directors, sign all documents, continue manage the teams operating in Ukraine, of course, that might trigger actually this issue. And to this point, place of effective management, just maybe one comment from Ukrainian standpoint is that if in other jurisdictions we will have situations that either the company is tax resident based on place of effective management and subject to taxation in this country or not, in Ukraine, if foreign entity has place of effective management in Ukraine, it can be registered and should be registered as a taxpayer in Ukraine, but will be subject to taxation not with regard the whole amount of profits generated, but only with regard to those which are Ukrainian sourced. So it's so-called territorial principle of taxation. So it's also something which differ Ukrainian concept from the worldwide concept.
Okay, so we go further then. This is an overview of tax rate. I assume everyone has already seen. What is here is important to understand that first, military tax or military special defense contribution, it's something that is special for Ukraine and it cannot be credited by that. It's not covered by the double tax treaty. That's why when we talk about tax credit, if something is taxed in Ukraine and then should be taxed, for example, in the UK, only personal income tax can be credited with respect to foreign income tax. One more thing is that we all know that in the past couple of years, Ukraine was undergoing through a tax reform. That's why when we have a lot of people trying to claim their Ukrainian tax residency, they have to understand that it doesn't exempt them from tax liability in Ukraine and application of all the rules that were also introduced as part of the tax reform, such as CFC rules. So CFC rules are effective this year. They basically apply to all non-residents owned by Ukrainian tax resident, and factually subject to this income of non-residents is normally subject to taxation unless the exemption applies, and there is always reporting obligations with respect to CFC. So I'm not going to go into details, but it's just to understand that in case individual claims Ukrainian tax residency and this individual has foreign companies, foreign structures, they are potentially subject to CFC rules and reporting in the Ukraine. And this rule would apply, and all the basic Ukrainian taxation rules would apply in case Ukrainian individual claims tax residency in Ukraine. So that's it about the Ukrainian side. It was just a small recap of the basic concepts. So it's easier to have a panel discussion afterwards and to talk a little bit about conflict of residences and possibility to claim tax residency in Ukraine or elsewhere in current situation. And now we go into the basic overview sessions for each of the countries. The idea is just for you to understand the basic definitions of residency for individuals and corporates and basic taxation rules in the respective jurisdictions. So when we have a panel discussion, we already can talk more about some special and specific matters. We start.
If I may, can you also specify the question we had the previous session, the difference in approach to Ukrainian individuals and the Ukrainian entrepreneurs that are also abroad, that there is some difference, okay? And also the reminder to all our participants that please leave your questions in our Q&A session, just for all the rest who joined us.
Yeah, so when it comes to individual entrepreneurs and natural person individuals, it's basically two different types of taxpayers. And that's why we shouldn't mix them. So what it comes to the tax residency of individual and taxable income of individual is one story, which is covered by the double tax treaty and which is covered by domestic legislation. When we talk about individual entrepreneurs, basically, it's a special concept that we have in Ukrainian legislation, which we sometimes in certain jurisdictions, we don't have that. And the question of taxation of individual entrepreneurs and income received by individual entrepreneurs, I think it's, I think Anna can comment here more, but I think it's now one of the most difficult questions we have, because the first question is how to qualify this income in the foreign jurisdictions, whether it's kind of a corporate income or whether it's income received by individuals. So it's a question of how the tax authorities of the special jurisdictions would consider. But it's nothing to do with the tax residency. So we should have to separate these two subjects.
Thank you. Thank you. Let's proceed with presentation.
So we start with Belgium. When it comes to defining tax residency for individuals, there's several ways the individual can be considered as a tax resident. First is the domicile in Belgium, and basically by default, it's registration with the Belgian authorities. If an individual is resident, then by default, it's treated as tax resident of Belgium unless proven otherwise. And when it comes to domicile, it's basically where the person factually, effectively, and permanently resides. And this one is also linked partially to registration with the local municipal authorities. Another important thing is the family. In case the family of individual resides in Belgium, basically it's non-refutable criteria for tax residency. So if the family is in Belgium, the individual would be treated as tax resident in Belgium. And it would be very difficult also in terms of double tax treaty to claim tax residency in any other different jurisdiction. Another criteria is so-called center of economic interest, or so-called seat of wealth. Basically, it's the place where individual manages its assets and where individual where the individual has center of business activities. So it's not necessarily where the property is located, but it's more where individual factually managing their property. And this is also one of the criteria used. And that's why, I mean, basically, we see that in case of Belgian tax residency, we go through all the possible ties that individual can have with the country. It's place of registration, it's place where the family lives, and it's place where the individual conducts business activities and managing its property or estate. So that's in terms of defining tax residency of individual. When it comes to legal entities, basically, Belgium incorporated companies should be by default considered as tax residents of Belgium unless they're managed in the foreign jurisdictions. And foreign companies which are effectively managed from Belgium should be treated as Belgian tax resident. When it comes to place of effective management, as Anna said, it's not like a special criteria, specific single one which applies. It's a combination of different characteristics that tries to point out to the authorities where the effective control and decision making is taken with respect to the company. On practice, it's normally the board of directors meetings and location where the company keeps its accounting records, stamps, seals, and documentation, where regular meeting where the correspondence is set, where signatories are located. So it's a combination of facts which allows the authorities to understand, okay, this company is effectively fully coordinated, controlled, and managed within the jurisdiction. Separate criteria, which is important, is a permanent establishment. As Anna said, it's pretty much most of the countries based the definition on the model convention, and it's kind of a fixed place of business where in the jurisdictions where the foreign entities carry on its activities. So, for example, if a foreign entity, Ukrainian company, as its employees with the signatory rights and who are doing, for example, sales in Belgium, this most likely would form a permanent establishment in Belgium. And then the question arises, which part of the profit of a Ukrainian company should be allocated to Belgium and which one should be allocated to Ukrainian headquarters and how they have to be taxed. However, in terms of permanent establishments, yeah, it's basically any kind of type of branch office, whatever facility that a foreign company has in Belgium and which is conducting activity on behalf of this foreign company. In terms of taxation, I mean, the tax rates in Belgium are quite impressive. So the individual tax rate is progressive up to 50%. And additionally, could be added some communal taxes. There is no wealth tax, but there is so-called solidarity tax on the securities. For legal entities, again, it's 20 or 25% tax. There are CFC rules introduced for legal entities only without that in Belgium. However, it only applies to low tax and non-cooperative EU jurisdictions. And there is also, of course, a withholding tax, which mostly applies in the double tax treaty provisions, actually. I think next is Netherlands. I give word to Anna.
Yeah, thank you. So about the Netherlands. So actually, let's start from the natural persons, so individuals. And here you can see criteria. And for example, you will likely meet here well popular and welfare rule of 183 days. It's again, as Anna already mentioned, that in fact, also we quite often rely on this criteria. It's not the only one, and in some countries, it's not the key one, let's say. So in terms of the tax residency in the Netherlands, the biggest concern in terms of when you define the tax residency would be the personal ties of person and its connections, his or her connections with the particular country, with the Netherlands. So basically, when we are talking about these personal ties, that might be the cases, for example, if in case of a married person, if the person moved with family to the Netherlands, it is likely that this personal ties might arise and the person may be considered as a tax resident. The same relates to the being durably intention to durably live in the Netherlands. So basically, if the person is a member of various local clubs or some societies, if the person has insurance and kids are actually going to school or kindergarten. So basically, this all is about those ties, personal ties, which make to believe that the person may be considered as a tax resident in this country. So it's not necessarily 180 days. We just would like to stress this once again, that the issue is more complex, and indeed it is important to assess all ties and all intention of a person to live where the family resides, if the bank account opens, and of course there is sort of link that there should be an intended length of stay in the Netherlands, which should be also taken into account, and availability of the permanent home, which not necessarily should be in the ownership of a person or a family. It's also one of the triggers that show that a person may be treated as a tax resident in the Netherlands. In terms of legal entities, the rules, again, there are two criteria. The first one is simple and basic. It's just the corporate seat in the Netherlands, so the company is registered and operated in the country under the local legislation. And another is obviously, again, the place of effective management. So basically, the place that if the Netherlands is actually the place when all important business decisions of the company, foreign company even, are being held, then if the directors live and operate from the Netherlands and all records of these operations is being held and maintained in the Netherlands, that's one of the signs that actually foreign entity may be, even if registered and incorporated in some foreign jurisdiction, may be still considered as a taxpayer in the Netherlands. And also in many double tax treaties, we have these sort of tie-break rules as well for legal entities, which again refer to this place of effective management, as already mentioned by us earlier, because in Ukrainian legislation there is no definition and there is no such concept for a recognition of the legal entity as a tax resident in Ukraine as a place of effective management. There might be issues with regard to double taxation of operations of the company, and those might be resolved under the double tax treaty. But as long as this situation with Ukrainian rules on place of effective management is quite new. There is obviously no practice of actual implementation of those rules, but that might be an issue because it's never tested yet, such cases. And there might be a question whether the tax actually paid in Ukraine by the Ukrainian registered entity, the taxpayer here, might be credited against tax liabilities in that other jurisdictions, in the Netherlands in this case. But that is something which is not, again, ruled, not tested practically. So probably if such situation arises, there might be need to receive some rulings on this particular matter, because it's something unique, which now businesses are facing. Therefore, not everything is actually regulated and ruled in this regard. So it's important matter to consider in case actually the management of the company moved abroad and, for example, resides now in the Netherlands. Permanent establishment, again, this concept exists also in the Netherlands with pretty much similar rules in terms of fixed place, in terms of employees being operating through this a fixed place. Probably something which I did not mention in the Ukrainian part of our presentation, but probably it's also a place to mention is here, that we need also to remember that in Ukrainian tax code now we have quite new rules which were implemented just recently, which might be called as exit taxation. So we need to understand that in case, because of the current situation, a lot of people migrated from Ukraine to foreign jurisdictions, there might be additional transfer pricing consideration in Ukraine which should be taken into account. So actually, if relocating of people will be viewed as relocation of function, which previously used to generate some profits in Ukraine, and now because people moved to another jurisdiction, that might be also be linked with moving of related profits to that other jurisdiction. This mere fact of the relocation of people, relocation of functions may be considered in certain cases as a controlled transaction from transfer pricing perspective, and then an arm's length remuneration for such relocation of people abroad and functions abroad may be considered as a taxable base in Ukraine under Ukrainian corporate income tax. So it's also something to remember that the relocation of people creates not just the issue of double taxation of their own profits and their own income, but also creates a set of corporate profit tax implications which should be considered and addressed. And that just to recall once again, it's a question of place of effective management, that's a question and issues of permanent establishment and potential exit taxation through transfer pricing regulations in Ukraine.
I'm sorry. And with regard to this point, for example, if a salesperson is abroad at this moment and he or she executes this function abroad and generates some additional income considering its functions and considering his or her possibility to be abroad, this will be the case as you mentioned now?
Well, probably one particular salesperson would not necessarily mean that the whole function has been moved to other jurisdictions. So definitely, if it's the only person in the company who has actually generated income, and because this person moved, all functions moved with him or her. But in fact, it's usually in companies you have a number of people being involved in particular function. So it's not just one person moved. So of course, if the whole department, for example, that were responsible for, I don't know, for marketing, for sales function in the group, in the company, they moved out of Ukraine to another jurisdiction, or decision-making people again. So it's very much important in all these risk assessment of the risks we mentioned. It is important to where the actually decision-making people are located, because they generally make all those decisions which are binding for the company. Therefore, where they reside, usually the risk might reside with them as well, as linked to their movement. So not necessarily one person, but it's more complex situation.
But here it's also important that we have to distinguish between place of effective management and permanent establishment. If one person does not necessarily mean place of effective management, one person can easily create a permanent establishment, especially it's very often in terms of sales. People don't like to set up separate subsidiaries for sales representatives in jurisdiction, and they just hire them for a headquarter company somewhere abroad, and this is kind of sometimes very typical permanent establishment case, because they enter in some SPAs and they find actively clients, and then basically the profit they generate should be actually taxed in jurisdiction where they are located. So I would say if one person does not necessarily constitute place of effective management, unless of course everyone goes to see him to sign everything, but it might be the case easily that it's going to constitute a permanent establishment.
Yes, I got it. But in any case, it will be a comprehensive analysis of case by case issue. Thank you. Thank you.
Yeah, so in terms of taxation, so in the Netherlands, there's progressive taxation for individuals, which might be up to almost 50%. Of course, there are some also deductions, tax deductions available and exemptions available, which means that effectively not necessarily the upper level of the tax rate would apply, but generally the good thing about the Netherlands is that there are no CFC rules with regard to individuals, and there is no wealth tax. So basically, it's just personal income tax, although the rate is quite high. So it is important to understand the level of income of a person to properly assess what might be the actual tax exposure if such person would be ultimately treated as a tax resident. In terms of legal entities, here we have CFC rules, so there might be taxation of foreign jurisdictions companies, but it's again similar to Belgium. It's mostly about low tax jurisdiction, also called non-cooperative jurisdiction. So it's usually jurisdiction with no double tax treaty or agreements on exchange of information. The tax rate is, I would say, average if we compare it with mostly Western reputable jurisdictions, so it's 25.8%. There is, however, a lower rate for so-called, let's say, small enterprises, which income is below the threshold stipulated in the tax code. And of course, there are withholding taxes, which might be decreased under the big network of the double tax treaty signed by the Netherlands. Yeah, the next country, the next stop is the Slovak Republic. So here I wouldn't surprise you with the majority of the criteria, but actually here we have the same rules for individuals about the availability of the place of permanent residence of person in the Slovak Republic. Here we have, however, specifically indicated rule of 183 days. And we have also the rule that which refer to the intention to stay permanently in the country in case the person has available accommodation to live there. But basically, so the same, actually, the same criteria or the same indications of the person being physically present in Slovak with apartments which are used. In terms of apartment, it is important to understand it's not just having it, or but it's more about accommodations that should be specifically intended for a permanent live. So if a person has even owned apartments, so the property in the ownership, it doesn't necessarily and automatically mean that the person would be treated as tax resident. So if, for example, this person used to use this real estate just for occasional cases, then one story. Of course, if the person moved there and live there right now with a family, that might be an indication that such person has place of permanent residence and live in the country. In terms of legal entities, quite the same. So we have the corporate incorporation and the place of effective management as the triggers for treating legal entities as a taxpayer in the Slovak Republic. So indication of the place of effective management is actually the fact that the key management and business decisions are being done from the territory of the Slovak Republic, even if there is no registration of such entity in the country. The same permanent establishment might be recognized as a taxable person in the Slovak Republic in case the same we have either branch or a place of facility that is being used by the foreign entity, employees of foreign entity for performing their daily activities or for the benefits or of the foreign entity. So basically an individual acting on behalf or for the benefits of a foreign company might be treated as a trigger for recognition of permanent establishment. That's exactly what Anna mentioned before, that even one salesperson technically can trigger actually a PE of a foreign entity in the Slovak Republic in case such person are negotiating some binding liabilities for the foreign entity, for example, for Ukrainian entity. Of course, the more people are located in particular jurisdiction and conducting the activity there, the bigger the potential tax exposure is and the bigger risk of challenges of permanent establishment, but generally that should be analyzed in order to assess whether such risk is high or low. And importantly, probably here to mention, we did not discuss it specifically, but we don't have at this stage, at least we will discuss it, I think, during our panel, that so far we rely on the general taxation rules existent in each of these countries, because there is no official clarifications for the cases like when all this risk technically arise due to the fact that people were relocated or were moved from the country because of the war. Therefore, there is no specific rules. In the past, we know that OECD, for example, they issued recommendation in terms of some force majeure matters which were related to COVID-19 measures, that in case, for example, such situation happened because people moved to other country or were simply remained in a particular country because they are unable to move to their home country, that in such case, it should not be treated as the fact that the permanent establishment arise or that such person change his or her tax residency. However, when we are speaking about the countries like Belgium, Netherlands, Slovak Republic, the same, unfortunately, we don't have any clarifications or explanation that either the same rules might apply to current circumstances or there are specific set of rules for such circumstances. Therefore, we here rely and refer to the general tax rules which are envisaged by the local domestic legislation and which might entail the relevant tax implication, which is for individuals. Anna, can you move next slide? Yeah, so in the Slovak Republic, we have again progressive tax rate for individuals, which might be up to 25%. There are also CFC rules introduced in the Slovakia for individuals, but again, it's relevant for, there are also threshold of income of that foreign entities for which exempt from CFC taxation. So in case Ukrainian person was treated as a tax resident of Slovakia, potentially there might be some CFC implication, but there are thresholds which will allow to exempt taxation of such persons' companies if the income is below a certain limit. And there is no wealth tax in Slovakia. In terms, Yeah.
I'm sorry. We also have one question, I think, relevant for any country, and it is quite general. How can a tax authority of EU country where a person had to move because of the war check if this person is still working for a Ukrainian company and receiving remuneration to be able to analyze if such income is subjected to taxation or not? I think that this can be relevant for any country.
Well, we are now, I will start, probably Anna will add. We are talking about the most interesting aspect of all these issues we are discussing. So it's basically detection by the tax authorities in case, for example, some auditing, and in case a person didn't pay, for example, tax, how the tax authorities may identify. I would say, obviously, it's not something very easy and obvious to everyone, but there is a set of tools which actually provides a tax authority possibility to do it. First of all, in some countries, people automatically registered with the tax authorities as part of their registry legalization in a particular country. That's one aspect. In most cases, people are opening bank accounts, and this information is also maybe made available to the tax authorities. Moreover, now because of exchange of automatic exchange of information, banks are also required to classify their clients based on their tax residency. So basically, irrespective of what I may believe that I am tax resident of Ukraine or some other country, the bank, while accepting me as a client, will assess my current circumstances and will indicate based on such analysis whether bank agree or do not agree or does not agree with my classification, and might indicate different status compared to what I believe I am, for example. Yes, so that's another part how the tax authorities may trigger information. And moreover, in some countries we have indirect methods of controlling and administration of personal income tax. So it's also aspects that's not necessarily to see which income person receive, but you can also check based on the expenses part of what actually person pay for. For example, if the person uses all like social, let's say, life triggers, like, I don't know, attending gyms, concerts, etc. It's obvious to say that even if the local bank account is just very minimal, kept at minimal amounts, there are still some income which is generated not probably from the country where the person resides, but probably from some other jurisdiction. So it's in brief. So there are tools. Of course, it's the question of materiality for the tax authorities for which cases they would like to make all this investigation. And of course, probably not each case would be interesting, but there are tools which they can apply. Anna can add.
Yeah, well, I think one of the things that we didn't mention, I could add also, is that normally in most of the countries, in order to obtain social support, you must declare all the assets and income you receive. And in case you don't declare, it's kind of a criminal liability. So that's why I would say in many cases, you voluntarily declare these assets. And if you declare your bank accounts, if you declare your employment, it's not a big problem for tax authority, even without exchange of information on bilateral basis, requesting information additionally from Ukrainian tax authorities. So it's not, in today's world, I mean, I would say that it's very, we hear a lot about the clients that are going to hide and no one's going to know. I mean, it's unfortunately not in today's world still relevant and possible. Okay, I will quickly go through the UK, and then we can move to the panel, and then we can answer more questions, actually, I think. So UK, I think, well, in terms of tax residency assessment for individuals, it's probably one of the most complicated ones you find in Europe in terms of number of criteria and ranges. But basically, if you talk about UK tax residency, you have two separate types of tests. You have so-called automatic residence tests and then significant type tests. And if you meet none of those, then you're non-resident. So when it comes to automatic residencies test on the slide, it's actually 3 criteria. So it's either 183 days or monetary if you have UK home, or being fully employed in the UK. If you don't have all these criteria met, then you have to go to sufficient ties and see what ties with the UK you have. And depending on the amount of ties, the amount of days is relevant. So the ties are typically, again, having permanent accommodation in the UK. Again, it's not necessarily owned property. It could be rented property. It could be your parents' house. It could be anything pretty much. Having family, having employment in the UK, and 90 days. So depending on the amount of ties that are jointly at the same time actually fulfilled or applicable, the amount of days spent in the UK would refer to tax residency. So in case you have an accommodation and family and some partially employment, or you exercise employment activities in the UK, you don't have to be only employed by the UK company. And you have 90 days, then this 45 days would be sufficient to claim tax residency. So this is basically coming to the question that 183 days is not necessary criteria for becoming tax resident anywhere, and in the UK as well. You can see that actually you can become tax resident already starting from the 30 days if you have only apartment in the UK, nowhere else. So that's about residency tests. So basically, again, I think you have to go really, in case someone is deemed to be UK tax resident, it's something worth analyzing, because being UK resident for several years would end up with significant tax burden. And there's also, apart from this, there's something called domicile, which is a separate story. It's nothing to do per se with tax residency. It's separate category depending on the ancestry of the people, their intentions, etc. We should be also analyzed, because if an individual is non-domiciled in the UK but tax resident, the individual can benefit from special regime and be taxed on remittance basis. So that's why when it comes to tax resident in the UK, it's kind of something very special. We should be considered separately. For legal entities, again, by default, you can have UK entities are general tax resident in the UK, unless they're effectively managed abroad. And there, for UK established entity, you have to always go through the double tax treaty. So in case you want to claim that UK company is not tax resident in the UK, then you have to prove that based on the double tax treaty, the place of effective management of the company is moved abroad, which practically means that you can have only UK entity non-resident in the UK if the country has a double tax treaty with the UK. When it comes to the place of effective management and control, again, similar like to all the jurisdictions, if a foreign company has a management and control in the UK, it is deemed to be UK corporate tax resident, which means that it's subject to corporate taxation in the UK. And here, well, there are, again, multiple factors which define management and control, which have to be considered jointly, but in practice, it should be, of course, the location of the board meetings, the frequency of the board meetings, attendance, votings. So basically, you have to actually look where the directors, in fact, exercise the management of the company and control of the company. And in general, is one more thing is important to make sure that directors do exercise management and control of the company. The fact that you have a director without any control or any powers in the registry doesn't mean a lot of things to you unless they do actually exercise their powers. And again, UK also, like all the jurisdiction, has something which is called permanent establishment. Similarly, we talk about any place of business inside the UK, which a foreign entity has. It could be, again, sales office, it could be in sometimes construction site, it could be anything, it could be also agent permanent establishment where the individual has a right to exercise certain deals and contracts on behalf of the company and actually exercise it. So again, permanent establishment concept, quite international one, and also present in the UK, and also can be easily triggered in the UK. When it comes to taxation, again, the tax rates are quite high.
Yes.
45% income tax. Also, there's no wealth tax, but there is inheritance tax up to 40%. Also, inheritance tax, please know that it's not only about residents subject to inheritance tax, non-resident are also subject to inheritance tax. That's why when it comes to UK assets, we always say everyone, you have to start planning in advance when you come to the UK. Corporate taxation also 90%, it goes to 25%. There was a increase adopted, I think 2 years ago. So it's take effect as of April 2023. CFC rules exist in the UK, actually for legal entities and natural persons. But again, if you have this special regime, if you're non-domiciled and resident in the UK, you can benefit from special regime on remittance basis taxation. Then you can mitigate this risk. But again, this regime should be claimed in the tax return, and you need to make sure that you can qualify for that. So again, if you're deemed to become a UK tax resident, even if you were not before, we strongly recommend that you talk to a local consultant, because there's a bunch of issues that you need to be aware in advance. Yeah, so I think that's part of the UK. I guess. Do we have questions? Okay.
Yes. Anna, we are, if that's it with the first part of our presentation, we can also move to our experts from PwC from other countries. And if you don't mind, I already have a question regarding UK and regarding Netherlands. We can start with them, and then we can proceed with peculiar questions to our colleagues. Okay. So we have one question regarding UK. I went to UK with my wife, rent an apartment or got a room from the sponsor and continue working on Ukrainian firm. That means that I meet all 4 criteria basically. I think that this relates to the criteria we mentioned, how to identify the residency of individual.
Yeah, good morning, everyone. My name is Valery. I'm a director at PwC London. When we look at UK ties, the specific person Vitaly is asking, so he has wife, apartment, and work. So he will definitely have 3 ties, but the 4th tie is 90 days tie. 90 days tie looks at previous year. So on the basis that Vitaly didn't spend 90 days in the UK in the previous 2 tax years, Vitaly will have 3 ties, and with 3 ties, 90 days will be sufficient to trigger UK tax residence. And this will mean that Vitaly will have an obligation to register as tax resident, file return, and report his income.
Thank you. Thank you. Okay, so we also have a question regarding Netherlands. Please comment on taxation for the pensioner who are currently in the Netherlands and receive living money support here, and at the same time continue to receive the minimal pension in Ukraine. I also think that this question, I also think that this question will be relevant for Live Luf. This is also ordinary practice to receive some support from foreign state, for example, for support on your baby or for pensioners as well. Yes, please, Maurizio.
Well, so this is quite a complicated question to answer right from off the bat. So basically, first you need to determine whether somebody is a resident. And residency is in the Netherlands based on quite a number of factors. One of them being basically, are you intending to stay here, and do you have your strongest personal connections in the Netherlands? Okay, but let's assume that is the case. Also, because you register with the Dutch government, and that in general triggers the situation that you will be registered as a taxpayer. You can have discussions about it, but that's basically the assumption. Your pension income is generally taxable in the Netherlands against the ordinary rates, but the ordinary rates depend on your age. So if you're more senior, your rates could be lower. So basically, it starts, I think, with 76 or something. Your rates will reduce. So generally taxable, but it does depend on where your income comes from. Is it from, let's say, a private employment, not state-related, typically it would be taxable in the Netherlands. If it, however, relates to state employment or to a social security scheme in the Ukraine, it could be that the Netherlands does not have the right to levy tax, but Ukraine should levy tax. Well, going into the detail of that is a bit difficult, and we may be able to answer this offline. But that's basically the field you need to cover. Is that clear?
I think yes. I hope that our participant, if she's here, she can comment additionally on this question. Okay, and I think that the next question also goes to you. I came to the Netherlands after the war, and they gave me temporary accommodation. I registered with the municipaliteit and received a BSM number, opened a bank account. I still work remotely for Ukraine, private entrepreneur, and receive income on a Ukrainian account. Do I have to pay taxes for the Netherlands? If not, when should I start paying taxes? Thanks.
Okay. Again, not a very simple question, but
I see that we don't have simple questions here. You know, each case is really very complicated.
As a starting point, we don't care on which account the money is deposited. So if it's deposited on a Swiss account, if it's deposited on a Ukrainian account, if it's deposited on a Dutch account, we don't care. It could be considered income in the Netherlands if the person is a tax resident in the Netherlands or basically exceeds, let's say, 183 days of work in the Netherlands. Well, yeah, it's an employer. So then it's taxable in the Netherlands.
I think, Maurits, I think it's a bit more, even more complicated question.
No, I know. I was
talk about private entrepreneur. So it's something like a self-employed regime in Ukraine that you have, like individual entrepreneur, where you kind of do exercise some business activities, and you have a special taxation regime. So
sorry, Anna. Is the private entrepreneur, is that an employer or is that the person himself?
It's a person himself, but it's like corporate person. So you kind of it's a special regime. Basically, you say it's like more like a firm with one person. Yeah.
Well, so then still, it's basically two things you need to go through. It's still complicated. It's two things you need to go through. First, you need to determine whether you're a resident of the Netherlands. And that BSN number typically triggers the situation that the Dutch tax authorities, by default, will consider you a resident. If you're not, you can argue such, and if you don't, you say I'm not a resident, you need to prove that you have closer ties with another country and you have no intention of staying here.
Okay. But I would say if it takes longer than a year, then the discussion whether you could argue that you're not a tax resident in the Netherlands, it will be a slippery slope, because then it's more likely that you would become a tax resident in the Netherlands.
Yeah.
Because then still arguing that your intention is not to stay here based on our, I would say, the law, that could be very difficult.
Yeah. So in that case, you're a resident. It's taxable. Exactly. It's taxable against progressive rates. There may be a possibility to get tax deductions for entrepreneurs, but that needs some further attention. And so then it's all taxable.
I think it's more also the question how you would actually recognize this individual entrepreneur in Netherlands. It's also a good question because either it can be a personal income, then you're subject to ordinary progression tax rates, and then because what tax individual entrepreneur, it's not really, it's kind of a special contribution that they pay. It's not like a so-called tax per se. So that's why I'm not sure whether we can actually even claim any double tax treaty tax credit here. And it's all whether it would be you have something like probably a sole trader.
If you're a sole proprietor,
it's more similar to this one, I would say.
I understand. So then also you have progressive rates. It's basically treated the same as your personal income tax, with the highest rate of 49, 0.5%. but you'll get extra deductions because we want to incentivize people to start their business, right? And eventually grow out into a multinational corporation with many, many employees in the Netherlands, and many companies never come there. But so that's how it works. So it will be taxable against progressive rates. And I would expect that if we say it's all taxable in the Netherlands because the business is operated in the Netherlands, we will not give a credit for foreign taxes. So if then also Ukraine would say we tax it as well, you'll have double taxation. So that, okay, if we would argue that the company is not of the entity, it is not a Dutch business and he is not a resident in the Netherlands, you would need to say he has a permanent establishment. And then the temporary bit of his, let's say, stay in the Netherlands, presumably he wants to return at some point to Ukraine. And that could be an argument to say, I do not have taxable nexus in the Netherlands. But as Marlou said, this 1 year threshold is quite a tough thing to beat if you're staying in the Netherlands for more than a year. And already with registering with the municipality, the BSN number basically means the tax authorities will by default consider you a tax resident.
Yeah, I guess individual entrepreneur recognition is a part for a separate panel. Because it's really, I think now, considering that this regime is extremely popular in Ukraine, especially among IT companies, it's really a huge separate story about it and recognition of this regime in EU and possibility to somehow at least credit the taxes paid in Ukraine with respect to EU liability. So it's a really complicated matter, I need to admit.
Yes, I also see that we have a general question how to define a private entrepreneur goes to individuals or to corporate legal entities. I understand that this is really complicated question and it depends on the recognition of this regime in any other country or something similar that can be there. And sorry, but again, question to Maurits, and is there minimum incomes in the Netherlands that is not needed to be taxed? This is like a general question, and also two complicated question like a situation. I am living here in Netherlands from the beginning of April in hotel for Ukrainians. I'm going to open BV. I'm really sorry, I don't know what does it mean, but maybe this is something
legal structure. Yeah.
Yes. As only one owner. Will this pact move me personally to the category of local taxation? I registered in Ukraine as entrepreneur, as we discussed previously, what does it mean? And have 2 working companies in Ukraine as well.
Yeah, well, so if you open a BV, sorry, I'm taking the floor all the time. If you open a BV, basically you'll have Dutch taxable nexus. So maybe he or she should reconsider. And review what the impact is, because if you open a Dutch BV while you're in the Netherlands, presumably it will be a Dutch tax resident for corporate income tax purposes as well as for for personal income tax purposes, and then the income of the entity, let's say arm's length income of the entity, will be subject to, what is it now, 25.8% corporate income tax, followed by 26.9% personal income tax, so quite a significant rate. Well, and then to build on that, so if that individual would have a share interest in a company that's not resident in the Netherlands, so possibly that this accumulation of taxes you may not have, or possibly also never have. But that's something that he would need to look into a bit more. So the message basically should be, do not incorporate the BV without thinking about it thoroughly, because it will create your taxable nexus in the Netherlands, and that can be expensive. Is that a good line?
That's a good one. Yeah.
And what about minimum income that is not needed to be taxed?
Well, that's another difficult question, very much dependent on the facts and circumstances. But let's say it's employment income. If it's regular employment income, basically about up to 17,000 euros, you do not pay any tax in the Netherlands. If it's above 17,000 euros, you start paying tax plus premiums at about 33%. And over the amount, the higher the amount, you'll build up to 49.5%. So anything less than 17,000, don't worry too much. If it's above, you become into a tax-paying position. But if you're an employee, the company you're employed with should also withhold the tax. So basically, it's not going to be your problem in that case. With some caveats there. If you're a sole proprietor, that amount is higher because of those deductions, right? So you can earn more tax-free if you're a sole proprietor than when you're an individual.
Savings.
Saving, yeah, no.
Yeah.
Go ahead.
And because there are other types of income as well, I would assume. And if you become a tax resident in the Netherlands, in principle, you have to pay some taxes relating to your savings accounts, for example. But we have a threshold there as well.
Yeah.
And it will become
100,000 for a joint situation, basically,
exactly.
if you're a couple. And then 100,000 euros is exempt of tax, but on the excess, you'll need to pay tax.
Exactly.
Going into the detail of that is going to be very complicated because there's a lot of case law around it as well, and the system that is currently in place is scrutinized quite a lot. But basically, it means that on a deemed income on your capital, you pay about 30% of tax.
Yeah.
Mm-hmm.
So if you have a very bad income on your savings, you'll pay more tax than you earn. If you have a good income on your savings, you'll pay very little tax.
Okay, I got it. Thank you. Okay, let's move to UK. We have several questions to UK. If I'm considered to be a resident of the UK, do I have to report and pay taxes from the first day of arrival to the UK or after the lapse of the respective period based on the number of tariffs? For example, after day 45, after day 90, and so on. Valerie?
Yes, so this question is connected to reporting, and reporting is connected to the question of a tax year. So the tax year in the UK runs from 6th April to 5th April of the following year. So assuming the individual in this question came to the UK during the period from 6th April to 5th April, we're looking at the whole year. If the individual spent, sufficient time to be resident, then after the 5th April 2023, there is an obligation to register for UK income tax purposes and pay the tax liability by 31st January 2024, actually. So the requirement to report and to pay tax arises in respect of the whole year, but you can file the return only after the year is finished, and there is quite significant sort of time for doing this up to 31st January 2024, if the individual came during the period from 6th April 22 to 5th April 23.
Mm-hmm. And a general question regarding their base for taxation. If you consider to be a tax resident of UK, for example, what will be their tax base? It will be your income gross, or how to understand what it will be?
Oh, I think it depends on the type of income which you have. So most of the questions we're seeing here, they relate to employment income. So employment income, if the relevant person works in the UK, it will be gross employment income. Mm-hmm. If you say have foreign passive income, such as dividends or capital gains, we have the concept of a remittance basis of taxation, which Anna has highlighted in her part. And the idea of the remittance basis of taxation is that you do not pay UK tax on income which is not physically remitted to the UK.
I'm sorry, we don't hear you. Anna, do you hear Valerie?
Valerie, probably you're muted. Can you please check your connection?
Now you're okay.
No, we don't hear you.
Okay, maybe try again.
Now?
Yes.
Yeah.
Is it working? Yes.
Yeah.
Yes.
So at what stage you didn't hear me? What was the last thing I said?
You mentioned remittance basis.
Yes. So the idea of the remittance basis is it works very well for passive income, dividends, capital gains from non-UK sources. You don't pay UK tax if you don't remit those money to the UK. The remittance basis doesn't apply for employment income if you exercise your duties in the UK during this period. So how much income you pay, it really depends on the type of income. For employment income, all gross income will be taxable, but we have a personal allowance, i.e. exempt amount of £12,500, and everything in excess is taxable at progressive rates.
Okay, thank you. And also one more question regarding UK. Could you please comment on the following situation with regard to their UK individual tax residency? I have moved to the UK alone. Parents are staying in Ukraine, have no husband, wife, children. Continue working for a Ukrainian company and living with my host English family without paying any rent fees to them. Should I register with the tax authorities in the UK after 182 days of staying here?
So there are two questions again. First is, what was the period during which the person relocated? I'm assuming this is from 6 April, i.e. current year 22 to 5th April 23. Then we'll look at the situation for the whole year. And then, judging from the question, the person will work in the UK for more than 40 days. So this is a work type, and also the property available accommodation is an accommodation tie. So we're talking here about two ties, which means that under the sufficient ties test, the requirement to register as a resident arises after spending 120 days. But actually, the registration comes in after the tax year finishes. So it will be after 5th April 2023. The persons in this question will have time to register and pay relevant taxes. It's Alena, so she will have to register for UK tax from till, and the deadline is 31st January 2024.
And in this case, it even doesn't matter, do you own some property, rent, or even live in a hostel?
Accommodation is defined very widely. It means just a place where you can stay. It doesn't require it to be owned, rented, paying. It can be property given to you by parents, friends, everyone, including this refugee scheme, which we currently have. And one important I think, clarification, it's touching on the next question from Victor, is in the UK, we operate the so-called system of self-assessment. The individual has to assess their resident status and file the return based on their circumstances. There is no mechanism for telling tax authorities that you are not resident or anything like this. After the end of the tax year, the individual has to review their days, their connections, the level of income, and file the return. There is nothing which you can do with the tax authorities. There is no mechanism for this in principle. The tax authorities will not talk to you unless you register for self-assessment, and the requirement to do so arises only after the tax year is ended. So there are no specific actions that should be taken. You just look at all your year, collect relevant information about your income days, and then assess your situation after the end of the year.
And can Ukrainian taxpayer write a letter request from MHRC to confirm his understanding of tax residency, or
no? It's usually works on self-assessment. You have to file your return, and then you determine whether you're a resident or not. The tax authorities do not give rulings on this. But there is a connected question. If you're working for a Ukrainian company, are you creating a permanent establishment for the Ukrainian company? So your employer may be potentially under an obligation to create some presence and pay, register you in the UK, etc., etc. But this is separate from the personal tax question. The tax authorities in the UK will not give you any clarifications in advance. So this route is not available.
Okay. As well, if you don't mind, I want just to extend this question actually to wider auditorium. Probably, Dominic, you can comment on the Belgian perspective, when it comes to all the Ukrainian peoples who moved to Belgium. Whether there is anything special that Belgian authorities, how they treat them in terms of tax residency, and B, if Ukrainians want to claim that they are not tax residents, do they have a possibility to confirm with the local authorities their view, or it's similarly just self-assessment basis, and if you misread the law, you misread the law?
Yeah, so it's a bit different in Belgium than it is in the UK. So the first thing is that people, when they arrive in Belgium, they can either, let's say, not really register, but only remain here for a short stay, which is 90 days. But most people will register with the commune so that they can also get access to the professional market and certain other benefits. In that case, it's clear that the tax authorities will, in first instance, consider this person as a resident, because it's actually written in Belgian law that if you are registered at the commune in Belgium, that you're considered a Belgian resident. Now, that is a refutable one, so you can refute it based on factual circumstances. And I personally believe that there is an argument that can be made there, in the sense that they get a temporary stay permit here in Belgium, so it's only temporary. So if you say that their stay is temporary for one side, I think that you can make the argument towards tax authorities that it's clearly that they should not be a tax resident. Whether that will be accepted is quite debatable, because let's say the temporary stay can be prolonged quite a long period, and it's certain that if a person would stay 2 years, for example, in Belgium, they would definitely be considered a tax resident. Different from in the UK is that here in Belgium you basically get an invite to send. Let's say you basically get a form sent to you, or you get an invite on the online platform where you can file your tax return. And it's at that moment in time that you as an individual can write back and say, I should not be taxed as a resident, I should be taxed as a non-resident instead, and you can make your arguments. That's the first route you can go. The second route you can also go is you can go and ask what we consider a tax ruling. So you can go and ask a tax ruling from the tax ruling service on your residency status. The problem is this is normally a process used to ask, let's say, more complicated tax questions. You can do it as a person, but most people get, let's say, assistance from a consultant or a lawyer, and it can be a relatively expensive procedure. There is nothing, let's say, really provided for specifically for Ukrainian refugees. So we fall back then a bit under the rules that you can see on the screen. So you can refute the domiciling BE, but if your family is, for example, located in Belgium, and family, that means close family. So, for example, your spouse, your children, etc. Then you are irrefutably deemed to be a tax resident in Belgium. Second is also if your center of economic interests are in Belgium, that one can also be a link. So if you are earning all of your employment income, for example, and you really live from that, then it's quite likely that the tax authorities will consider you quite quickly a resident of Belgium. But the mistake we sometimes see in recent advices also given to, unfortunately, Ukrainian refugees is that there would be a period of 24 months before you become a tax resident. But that's actually not the case. The 24 months period is only works when you are a tax resident of Belgium and you're leaving Belgium. Then you need to leave Belgium for at least 24 months to become a non-resident. But it does not work the other way around. While you can make the argument towards the Belgian tax authorities, I've been here less than 24 months. Not all of them will accept it because it's strictly speaking, only in the other way around to break tax residency, not to require it. I think that's a bit the overview for Belgium.
And then, yeah, sorry.
Yes, Anna, proceed. I just will ask several questions then.
Oh, okay, regarding Belgium. Yeah, but this 24 months would apply if, for example, this year individual qualify as Belgium tax resident, and then next year, for example, they move out of Belgium back to Ukraine. So then they have to continuously live for 2 years in Ukraine, and for this period, they will still have Belgian tax obligation, or how it's going to work?
No, so you immediately break your tax residency, but for example, if you would leave for Ukraine for 6 months and then come back, then they will consider you a tax resident for the entire period. That's the only remark there is that the 24 months is again not strict law. This is a point of view from the Belgian tax authorities, and it's basically what they consider a bit of a threshold. However, if a person has, for example, leaves back or goes back to Ukraine, is there for a few months, but unfortunately the situation becomes too dangerous again and comes back to Belgium, then there are good arguments that that person did break his or her residency because the person had an intent to remain away for longer than 24 months. but it's basically there to avoid, which is something you could do in the past. You live a few months in Belgium, you live a few months in another country close by, and so on, and you don't have tax residency anywhere. That's no longer possible due to this 24 months rule.
Okay, Dominique, and we also have some practical questions also related to accommodations. The lady moved to Belgium with her son. She is divorced. She is a private entrepreneur in Ukraine, have an apartment in Ukraine and in Belgium. She rents an apartment. Do I need to pay taxes in Belgium and when? And I think that question also connected to this is regarding how is counted 183 days in Belgium, calendar year or any 1 year period?
Yeah, so I will maybe start with the first part. So the 183-day rule, which is the typical rule of when is employment income taxable, that's one of the, let's say, conditions. In the treaty between Belgium and Ukraine, it's any 1 year period starting or beginning in the taxable year. However, so the person that asked the question also said that she's a private entrepreneur.
Mm-hmm.
Typically, and I don't really know that system very well. So, but my first idea is that person would be considered a self-employed individual in Belgium. So basically, somebody who does not, let's say, have a company, but is the company him or herself.
Mm-hmm.
Well, and that's quite close to what exists in Belgium. It's less common in the Netherlands, but it's very common in Belgium. Well, those people, they're self-employed, they need to register with the cross-point bank of companies in Belgium to get a VAT number and things like that. And they will also need to register in principle as a self-employed individual and pay Social Security as a self-employed individual. So the best would be to reach out to we call them the people, let's say, in charge for the self-employed Social Security. And there are several companies who assist there because you affiliate via one of those companies to see, okay, what should be, let's say, what you should do and so on, because they can do it for you and it's the easiest way and not that expensive. The question is then how does it work in terms of taxes for the rest? Well, a private individual normally needs to make some tax prepayments throughout the year. Otherwise, if you just file the taxes at the end of the year, there is an increase of taxes, which is not that high, but it's still important to take into account. So those are my first, let's say, remarks. Due to the fact that the son will be living also in Belgium, there is the non-refutable part that, okay, the family is located in Belgium, so the person should be a tax resident, normally as from day one. Again, you could try to make the argument that it's temporary and therefore should not be a tax resident, but I'm quite certain that the tax authorities will just say, look, the legal, let's say the law says that if your family is located in Belgium, that you're a Belgian tax resident.
Okay, I understand you. And if you register like a self-employed person in Belgium, but you still receive income only from Ukraine as the Ukrainian entrepreneur, does it matter for these prepayments?
Well, if it's normally if it's a self-employed individual, you fall under the article for self-employed individuals, which means that you are normally taxable in the country where you are tax resident. So that would be Belgium. Unless you have, let's say, you can show that the real place where you provide the services and so on would be in another country, which would be then in Ukraine. I think the argument would be much stronger if you could indicate that the Ukraine tax authorities are still considering you as a tax resident and are going to tax you fully in Ukraine. Then I think there might be some room for negotiations with the Belgian tax authorities. But I think it will be very dependent on the inspector which you face as whether he or she will agree. The easiest, or let's say the best way, is to go and ask again the tax ruling service, because those are people specialized in very complicated discussions, also are politically appointed, so they do get support from political parties to sometimes make braver decisions, like, for example, considering Ukrainian refugees as non-residents. Maybe they might have the power to do that, but it's not an easy way, because you need to file a request, you need to explain why. So doing it as just a private person is not that easy.
Okay, thank you very much. And let's maybe introduce also Slovakia to our discussion. I also have one question with regard to this. The director of the Ukrainian LLC is now in Slovakia, has, sorry for maybe not right reading of this, dokazne utosisko status, together with kids, has no Slovak bank account open. Is there any triggers that can be treated by Slovak tax authority as a legal entity decision are made in Slovakia, even if legal entity is not in Slovakian registers, and leads to potential taxation of the Ukrainian LLC?
Okay, so maybe just a quick introduction to Slovakian reality. So unfortunately, as of this moment, there were no changes in the legislation and no official guidance or some methodological materials issued by the tax authorities. What we have at the moment in the law, that the place where key decisions are taken, if this is done in Slovakia, would be qualified a company to be a Slovak tax resident. Therefore, formally, from a formal perspective, I would assume that this director moving to Slovakia will run his business in the company and would, let's say, actually take the decision and run the company. So in this perspective, formally, this would trigger tax residency for the company in Slovakia. Of course, it is a question for the Slovak tax authorities whether they would accept materials issued by OECD with respect of COVID and temporary changes in the law. But at this point of time, the situation is not clear. So what I would recommend to do at this point of time is to seek for a ruling to the tax authorities, because we expect that there may be issued some materials in this respect, but most likely it would be close to the year end, because in Slovakia we have a general calendar year with a filing period for the company in March or March 2023 next year. So tax authorities have a right for this. But from a formal perspective, once the place of effective management is moved to Slovakia, there is an obligation to the company, even if there is no legal registration in Slovakia. I mean, the registration is a commercial register. There is a liability for the company to submit a request for registration for tax purposes till the end of the month following the move of place of effective management to Slovakia.
Thank you very much. And one question from my side, do you see any intentions or movements from local tax authorities or maybe in cooperation with some Ukrainian authorities regarding some possible letters or explanations that can exempt some kind of income of Ukrainians that fled due to the war to Slovakia? For example, like if I'm not mistaken, Poland did that. They had the explanation where some type of income of Ukrainians that are in Poland are exempt from taxation. Maybe you heard about such initiatives in Slovakia?
So you mean for individuals, right? Not like a corporate entities, but individuals.
Yes, individuals. I saw only some explanation with regard to individuals.
Okay.
Yeah, sorry, we are not aware of any such documents or being prepared or anything planned, really. The Slovak tax authorities are very much sticking to the law that is in place, that doesn't include any provisions regarding the war. The only thing that we've heard from them, which is kind of more welcoming, is they are more likely to treat or to view the individuals as non-resident in Slovakia because they consider their stay in Slovakia as temporary. But this is just one interpretation that we've heard, and it's not official. And honestly, it's not based on any kind of law or anything. So I would be hesitant, or it depends really on the risk nature of the individual. of whether to take these kind of explanations and take the advantage of them, or whether it would be better just to be rational and go by the legal provisions.
So in Slovakia, the statute of limitation is up to 11 years. So that's why our authorities are not very quickly in respect of all these difficult items.
Okay.
Alex, maybe one more question to you, which we raised to also to other countries. Considering the quite long statute limitation period and considering that there is no explanation official, does it make sense to try to approach tax authorities and, as we discussed with other jurisdiction, to send some explanatory letter which will allow to fix that the person, explain why the person believes he or she is not a tax resident in the Slovakia Republic and is tax resident in Ukraine, for example? Would it work? Is there such mechanism, or it's again self-assessment of person based on each annual result?
We have only self-assessment system. The tax authorities will not issue anything. Even the individual can ask, can explain the situation, and they can reply in writing, basically. But everything is considered as unofficial. And even the authorities always say that this is based on the limitation of information that you provided, that this is not binding, and etc. So I would not be really relying. It can be a guide. The individual can try it, but it's not something that would be legally binding really on the authorities in future in case of any audits.
But we know that currently Slovak tax authorities are receiving a lot of questions from Ukrainians and from other advisors about all these residency issues, taxation of Ukrainians issues. So maybe there would be some letter of clarification issued by the tax authorities. It's okay, which is not binding because they can't override the law, but which would give us more clarity about the issue.
Yes, you're right. I think that number of Ukrainians are waiting for such clarity and clarification. And one more question also to you guys. How many days the Ukrainian company director shall spend in Slovakia to become liable to report the Ukrainian company as a Slovak corporate taxpayer?
We do not have any time period for the place of management criteria. So formally, from the first day when the K decisions place was moved to Slovakia, this would be let's say counted. And it is a very good question, which is, let's say, represent a gray area where the company would be considered as a tax resident for the whole year, for calendar year, or whether there is a possibility to claim that the tax residency, like liability to tax the income of the company, occurs only since the day when this effective management was moved to Slovakia.
Yeah,
so these are open questions as of now.
May I also just, when we touch place of effective management question, just to clarify, in practice, based on your experience, how Slovak tax authorities would be practical and enforce place of effective management for foreign entities? So they would.
Are you asking how they identify that some company would actually have a place of management in Slovakia?
Yeah,
it's a very difficult question in practice because it really depends on the circumstances. If there is let's say real office, maybe the identification risk is higher, but we saw in practice a lot of cases where tax authorities were informed by third parties that there is something wrong with particular taxpayer, and this was the action resulted in tax audit. Furthermore, for example, with respect of permanent establishment risk or issues, in the law we have an obligation for the company or anybody else to inform tax authorities that Slovak company is signing some agreement with non-resident company where such agreement may trigger permanent establishment registration requirement in Slovakia. So there are a lot of possibilities, and frankly speaking, I would not say that this is impossible or something like this, because this is always a matter which can't be predicted.
Mm-hmm. Okay, and colleagues, I also have one question related to Netherlands, but I think that it can be relevant for all countries. Generally speaking, how fast you can lose your tax residency of foreign country, I will make it more general, if you intend to stay in Ukraine permanently. So if you return to Ukraine, maybe we can comment on this.
I would also add here, if you can, sorry, if I just would also, if you can also partially comment in light of this question on the exit taxation, if you have any, when individual moves from EU country to non-EU country, that would be also nice.
Okay, so in this case, we would assume that your tax residency for personal income tax purposes ends immediately when you leave the country. It is different for certain other types of taxes, such as inheritance and gift tax. And then you have a reference period of either 1 year or 10 years. It depends a bit. As regards the exit taxation, so if you have been a tax resident of the Netherlands, you indeed have an exit taxation, which can concern hidden gains and retained earnings build up in your company and pensions build up when you're in the Netherlands. I think that's basically covers it all. And that does not result in immediate taxation. There is a scheme for it to pay it in installments over a period, and also depending on when you actually withdraw the money. But that's basically how it works. So long story short, your residency for income tax purposes ends immediately when you leave the country. There is an obligation to report an exit tax. Exit tax is not immediately payable, but possibly in installments or over a period of time. And the rules differ for a gift tax and inheritance tax. Then the reference period after leaving the country is either 1 or 10 years.
Good, thank you. Maybe we can also listen to other countries, Belgium or UK and Slovakia with regard to this.
Yeah, let's start from Dominic about Belgium.
Yes.
Okay. So in Belgium, you would break your residency. So if you're a Belgian resident and you break your residency going back to the Ukraine, you basically need to file a special tax return, it's called, within 6 months of your departure. And the taxable, let's say, period will be as from the 1st of January until the day that you deregister from the commune and leave Belgium. That's for income tax purposes and social security tax purposes. Other taxes can differ, but those are the main ones. There's no specific exit tax provided for under Belgian law for individual taxpayers.
Mm-hmm. Okay.
So in respect of Slovakia, we do not have exit taxes for individuals, but we have an exit tax for corporate entities in Slovakia, meaning that if Ukrainian would decide to organize a company in Slovakia and move his business to Slovakia, and then in, let's say, a couple of years decide to close the business, but not just to close the business, but to move the business back to Ukraine, this based on the current legislation would trigger exit taxes. So we would say that in general, this is a sale of business back to Ukraine where the profit should be taxable in Slovakia.
Mm-hmm. And what are rates for such?
Like this would be subject to ordinary rate 21%.
Uh-huh. Okay, thank you.
And how is it to become non-resident? Like if this year I'm resident in Slovak Republic, next year I have to just officially move, or I have to notify authorities? Or
yeah, it depends. So if you moved your place of effective management this year to Slovakia, you would be considered as a Slovak tax resident. And then in the next year, you would move your place of effective management back to Slovakia or back to Ukraine. So you may have permanent establishment still in Slovakia if there would be something left in Slovakia. But if you would totally move everything back to Ukraine, then this will be considered as an exit from Slovakia and subject to tax.
Okay, and Valery?
Can you hear me?
Yes.
Very good. So two aspects to this question. One is a personal side, and second is corporate. Similar to other countries which we discussed, there is no exit taxation if an individual stops being a UK tax resident. So UK doesn't tax you on the basis of the fact that you were in the UK, and so it's not like US or sort of some other countries. So it's very easy from a tax perspective in the sense that you don't have to pay any additional tax charges if you stop being a resident, but you have to file a UK tax return in which you will then claim that you are not resident. And how easy is it become a non-resident? Again, we have to look at the same test. What are your connections with the UK? What, how much time you spent in the UK during the relevant year? If you spent, say, 183 days and then leaving, then you are still resident. So it's important that the timing of your leave and the number of days you are spending in the UK is carefully managed if you want to stop being resident, for example, next year. Otherwise, if you spend like 120 or 183 days, depending on your ties, you could still be resident for the rest of the year, even though that you left the UK. And the second aspect to this question is corporate. If you are, say, a director of a UK company, and the UK company, or if it's a foreign company which is managed in the UK, and then you are leaving, then there is again the question that management of this company has moved from the UK, and this is under UK corporation tax principles triggered as a disposal, deemed disposal of the assets of the UK company. So there is exit taxation at the level of the UK entity if, when the person is leaving, he is leaving as sort of director of the company and he moves management with him. But this is possible to mitigate. First question is, does the UK entity have any significant assets? And second, do you leave any management in the UK after you leave? So subject to careful management, there would not be any significant tax charges, but you have to look at your days and ties. Summary.
Okay, thank you so much. Colleagues, I also have one question regarding Spain and Bulgaria, but considering that that Spain was—
I think, yeah, we can address that.
Yes, I will put it to our written answers. I will just inform you. From my side, at this moment, we covered all questions from our audience.
There is still something about the UK and Ukraine, if you can see, Yaroslava.
Yes, you are right. But I saw that we slightly covered this question. Does it mean double taxation in UK and Ukraine if I still pay taxes in Ukraine? I think that this is also relevant for a number of our participants today, because a lot of them are Ukrainian employees of Ukrainian companies. So we still pay taxes in Ukraine, as well as private entrepreneurs. They are also taxable according to Ukrainian legislation. Yes, Valerie.
So you're happy for me to take it first, and then we can talk about other countries. I think there is a concept of UK residence. When someone becomes resident, then he is liable to pay taxes in the UK on worldwide income. But there are different ways how you provide sort of credits and relief for income which is taxed in other countries. So first thing, we have to look at the type of income which we receive, and then if this income is taxable in Ukraine, there is credit available in the UK. However, we have to look at the double tax treaty to see whether Ukraine has really kind of valid taxing rights, because what the UK, I'm seeing quite frequently, some individuals, for example, they're paying tax outside of the UK and then they're claiming it in the UK. The UK tax authorities are saying under the treaty, for example, foreign tax should not be 20%, but it should be 10% or 0%. And you have to go to the foreign tax authority first and try to mitigate foreign taxes. And after you mitigated them, if this is in line with the provisions of the double tax treaty, then UK gives you credit. So there is a question whether the tax paid in Ukraine is in line with the treaty provisions or not. The second thing which some countries touch, but I didn't really touch significantly in my part of discussion, was about the concept of center of vital interest. So even if you are triggering residence in the UK, then you stay resident in Ukraine. We have a double tax treaty, which then says, where is your center of vital interest? And if your center of vital interest stays in Ukraine, this also provides various exemptions and reliefs in the UK, because you're then taxable only on UK source income, as opposed to your worldwide income. I think that, Yaroslava, you mentioned clarification by the Polish tax authorities, who said that if you're moving to Poland and you keep your income sort of in Ukraine and you not receive something from Polish sources, then the Polish tax authorities, as a general principle, will regard such refugees as having center of vital interests in Ukraine. This is quite, important clarifications. It gives, Polish authorities quite significant sort of clarity as to how to treat such individuals. In the UK, this principle is also valid. You can do it, but the UK tax authorities are unlikely to give you any kind of clarifications of a general nature, because they like to look at individual circumstances of each individual. What do they have in the UK? Are they coming to the UK temporarily or permanently, etc., etc.? So we're unlikely, my personal view, to see any general clarification which would say everyone moving to the UK from Ukraine is having central vital interest in Ukraine. But it doesn't mean that in individual cases, individuals cannot assess their own circumstances and still treat them as treaty resident in Ukraine. And there was one recent case in the UK relating to the Oppenheimer. It's a grandson of the founder of the De Beers diamond company, who lived in the UK for a long period of time, spent significant time here, but he maintained connections, business, cultural, family to South Africa, and he was successful. I think there was a period of over 5 years when he successfully proved in court that he was treaty resident in South Africa. That is why UK couldn't tax his investment income. So this case gives you quite good authority, and it establishes the approach which the UK authorities and courts look at. It's a 50-page actually examination of your circumstances, where do you live, etc. So reliance on this test is likely to be associated with significant discussions with the tax authorities. So not everyone will do it, but in some circumstances it's worthwhile. So there is a combination of different mechanisms how we can give relief, and the most appropriate one will depend on individual circumstances. So this is my conclusion.
Thank you. The first country that did something very similar was Ireland, and this concept of intention and your desire to stay in some country permanently or temporary, and due to what reasons, I think it really will play its role, because the circumstances we are in, they are not ordinary. Okay, let's also
I would just one thing, probably also with Ireland in general, I would be very careful when it comes to probably special rules for, let's say, taxation of employment income and overall tax residency, because Ireland didn't also confirm that Ukrainian residents, Ukrainian refugees should not be treated as tax residents. It's not about this thing, and that's something very important that we are talking here about. So we have to differentiate between potential exemption of employment income in case it's received for more than 183 days in the country, and based on the double tax treaty, the country has a right to tax, versus overall tax residency and reporting obligations for individual. And when it's, for example, someone is receiving local income or someone is receiving worldwide income, I mean, it does not exclude application of general taxation rules based on the domestic legislation. So here, I think that's one of the biggest confusions we see now among the people, is that they think that these new clarifications sort out all the taxation questions, yes. But it's not actually. And so far, what we've seen in the last panel, what we see in this panel, is that all the authorities, of course, have understanding that these are definitely special circumstances that Ukrainian individuals were put in, because that's why they ended up in Belgium, Netherlands, or whatever. But otherwise, it does not actually, they shouldn't ignore anyhow the provisions of the taxation legislation in any jurisdiction. So there's no special part of the tax code dedicated to people coming from Ukraine. And I think during last panel, our German colleague made a very good comment, actually. Ukrainians, unfortunately, are not the first types of refugees that Europe faces. And one issue that they see is that if they now create some official special rules for Ukrainians, is the question why they were not created for other jurisdictions before on special occasion. So that's why we need to be very careful in terms of interpretation of the law and the answers on the very special questions asked to the tax authorities, which are, by the way, as our colleagues from Slovakia mentioned, I mean, which are not binding in any sense. That's why I would be here again very careful in terms of claiming that, okay, we are now tax residents in Ukraine and everyone is happy about it.
Okay, thank you, Anna. This is really essential clarification. Let's move with this question to Dominique. Can you comment?
Yeah, so it's still the question about double taxation. There will, in principle, be no double taxation between Belgium and Ukraine, because even if both countries would be of the opinion that they would have the right to levy taxes, you can start a procedure of bilateral discussions between both countries. And then basically you put the responsibility of determining who is allowed to tax one of those countries. There is, however, a procedure that you need to invoke then, which can take quite some time, because of course the two countries need to first get in contact and then need to come to a conclusion. What we typically see is if there's issues with respect to double taxation for private individuals, so not assisted by a lawyer or a consultant, is that they reach out to the mediator. So the Belgian, there's let's say, a person who is considered the mediator, who also handles Belgian tax affairs. So you can go to, if you disagree with the position of the Belgian tax authorities, and you have filed a claim, but it did not, let's say, it did not work, they still do not agree, you can ask the mediator to intervene. And the mediator is even specifically mentioned on the website for Ukrainian refugees, that in case you have any discussions regarding taxes, etc., you can reach out to the mediator. That said, of course, the mediator is not a magic person either. So I think the arguments made earlier are quite good in the sense that the law remains the law, and we are very skeptical, at least in Belgium, whether there will be many amendments made. But the mediator does, let's say, could potentially also, if there is, let's say, double taxation and Belgium does not want to buckle, it could be worthwhile to request the mediator to intervene. But in the long term, normally there should be no double taxation.
Okay, I got it. Thank you. Maurizio and Marloes, can I give the floor to you on this question?
Yeah, sure. In the ideal situation, there would not be double taxation, right? Because you have the treaty between the Netherlands and the Ukraine. So one of the countries, either Ukraine or the Netherlands, has the right to tax. But I think in practice, you may have a discussion, and I understand that this private entrepreneur thing has a specific status in the Ukraine, where maybe that could result in questions quicker. And so, like in Belgium, there is a mechanism under a treaty to discuss how this should be solved among the two countries involved, Ukraine and the Netherlands. So eventually, also again, on the long term, no double taxation should be there. What I would expect in practice is that if you run into double taxation, and definitely if you are a temporary resident of the Netherlands, the Dutch tax authorities may be lenient and practical. But if you explain, so I'm also considered a resident in the Ukraine, even though technically you may not agree that this is temporary, and this is also a very extreme and nasty situation. Can you agree to this and this approach? I think that could land in fertile grounds in the Netherlands. So I would expect that there would be a possibility to avoid this double taxation, either in a practical way or in a very formalistic way.
Okay, thank you. And Zorana and Vladimir.
In Slovakia, for the individuals, the double taxation would occur if the work is really for the employees, for example, if they are paid really from the Ukrainian company for work which they are performing in Slovakia, and the source is really in Slovakia, so they are here more than 183 days. then the tax would arise in Slovakia as well. And as far as I know, yeah, it's difficult to claim it back from the Ukraine. So Slovakia, I don't think will accept and be able to claim tax credit for the taxes paid in the Ukraine if it was not rightfully withheld.
So you cannot do a tax credit for personal income tax paid abroad, or how the normally tax credit system works if you receive foreign income and you're a tax resident in Slovak Republic?
You can, and actually on employment income, we can claim exemption, but of income which was rightfully taxed somewhere. So the question is really whether the Ukraine has the right to tax that employment income, or is it Slovakia? So we would just go strictly by the double tax treaty and assess whether the income, but usually it would be then sourced in Slovakia. So the Ukraine has no right to tax the income for work performed in Slovakia.
So they treat it like so if the one wants to make it compliant, then they have to set up a branch and consider it as a Slovak sourced income, or how it should work?
Yeah, the employment income, yes, the employer is required to register as a foreign taxpayer with respect to payroll tax, and to tax the employees in Slovakia. So the tax definitely has to start to be withheld after 183 days. The company kind of has the employees in Slovakia, so they should register and start paying taxes. And this is really tax for Slovakia because the employment is done in Slovakia and not in Ukraine. So there would not be possibility to claim, avoidance of double taxation for this employment income.
Interesting.
Yeah, I think it's because of the way how the treaties work. If you look at the treaties, if you're a resident in Slovakia, then the employment income shall be taxable in Ukraine, like the same concept as in the UK treaty, only if the relevant individual exercises employment in Ukraine. So Ukraine has no taxing rights. That is why the UK will say, we don't understand why Ukraine isn't taxing you if you spent all your time working in the UK. But it's just a practice in Ukraine when employers in Ukraine, they're taxing you. So the only mechanism I can see in this situation is to either go for mutual agreement procedure or to explain to inspector to HMRC the circumstances of the situation. But technically, it's really difficult, and they can see the same situation as in Slovakia in the UK as well. So that's just the way how the treaty works, and you can claim only taxes which are in line with the provisions of the double tax treaty. So the Ukrainian approach has to be considered in this light.
And in terms of legal entities, so if we are talking about situation where management was moved to Slovakia, so this caused a tax residency in Slovakia, then tax authorities and the law would require that the worldwide income of the company should be taxed in Slovakia. But then there would be a question what was left in Ukraine, because if there would be a permanent establishment of Slovak company in the meaning of double tax treaty, then some part of taxes paid in Ukraine, which are, let's say, properly attributed to such permanent establishment abroad, maybe somehow recovered in Slovakia. But again, this is like a practical matters, and how Valery mentioned. So these are based on the double tax treaty, and double tax treaty would allow us to reduce double taxation only in the case where second party applied the taxation up to the limits of the double tax treaty. So we would not be able to recover something above the limits. And then there would be maybe a practical issue how to recover taxes physically paid in Ukraine.
Yeah, this will be a serious question. Vladislav, thank you very much. And my apologize for wrong name at the very beginning.
Oh, no worries.
Sorry, really sorry. Anna, I still see that we have several questions in our chat, but we run out of our time. And I understand that everybody is tired a little bit of this 2 hours marathon of practical questions. My suggestion is to put that questions into our written Q&A block that we will circulate among our participants together with presentation and together with recording. Maybe you have also some words, maybe you want to say some words as well, because I want to say a great thank you to all participants of our panel discussion for all these presentations and really insightful and practical answers. And I believe that it was really valuable for our audience as well.
Thank you so much. Thanks a lot, Jaroslav. Thanks everyone for joining us. Thank for the colleagues for finding a time to participate. I guess the major outcome was for everyone is that it's very complicated issue. It's tax residency is something very basic on one side, but very complicated to assess on the other side. And it should be done always on a case-by-case basis. So we've talked today about a lot of different questions, example situations, but again, every case is unique. So far, what we can see, we cannot have equal treatment for everyone. So please think about it in advance and don't try to apply generic rules to yourself. And B is that you see that it's not only about, even employment income is very difficult now to understand how to tax, but it's not also about employment income. It's also about lots of problems for corporations and legal entities in Ukraine that they will face now or in future, because you see the statute of limitations, like 11 years is crazy. I mean, you never know at which point of time you receive a notice from the authorities. So you need to really make sure that everything is now accurately, the most accurately compliant way done. And it's better to think about it in advance and not to wait for a notice or a letter from the authorities. And yeah, we will try our best to answer your questions. Some of them are very, actually, it sounds easy, but they're very complicated. So we might need some more background information to be able to answer them. But yeah, thanks a lot for having us. Thanks a lot for providing this amazing platform to talk to real business. And yeah, we're looking forward to the questions.
Yes, thank you so much. Thank you everybody for your great contribution. Thank you to our participants for their active position. I wish everybody a good day, safe day, and hope that at this moment we will be more equipped with different information and approaches, and we'll think in advance about this question that is really hot nowadays. Thank you so much. Wish you a nice day and goodbye. Bye.
Bye.
Bye. Thank you.
Thank you.